Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about borrowing capacity and what you should consider doing or alternative to consider if your borrowing capacity isn't sufficient enough to allow you to buy an investment grade property. So before I get into that, there's sort of three points I'd like to talk about or remind you of, and there have been previous episodes of this podcast, and you will find links to those episodes on the blog and the website, and it's in the show notes and so forth. So the first one is, firstly, it's my thesis that property investors need to be a lot more selective about which properties they invest in. In the past, property investors have benefited from a rising tide, substantially driven by rising borrowing capacities, and that's been driven by banking deregulation and a lot of competition within the banking sector, and driven by the internet a lot because it's informed people on different lenders give you different borrowing capacities and so forth. So there's been a rising tide. However, borrowing capacities will be stagnant, I think, in the future over the coming decades. So we're not going to be able to rely upon that contributing towards property price growth. And therefore, it's my thesis that the fundamentals of a property, buying a good quality asset, will matter a lot more than it has over the last 30 years. 30 years ago, if you bought property almost anywhere in Australia, you've probably done well because of that rising tide. Well, I'm not sure that is going to continue. Secondly, I did an episode about the fact that borrowing to invest in property works because of the borrowings, not really because of the property per se. So often people espouse the benefits of investing in property, but it's really gearing. And I concluded that episode by saying it shouldn't be a property versus shares decision. It really should be a gearing versus no gearing decision, although I might turn that on its head in this episode. And finally, I've talked about the fact that borrowing capacities have reduced by about 30 to 40% over the past year, mainly because the RBA's hiked interest rates by 4% over the last 11 months. Thank you very much. But it just means that it's a lot more difficult today to be able to afford a investment grade property. And then the problem is that if your borrowing capacity is restricted, you might be tempted then or you might be forced, in fact, to invest in a subgrade property asset, and that's not a good thing to do. So if your borrowing capacity is restricting you from a budget perspective, and you don't anticipate your borrowing capacity improving in the future, then you really probably shouldn't invest in property. To my mind, you either do it well or you don't do it at all. The quality of the asset that you invest in is going to determine your long-term returns. And you can't expect good quality returns from an average quality asset or even a below average quality asset. And remember the blog that I did a few months ago that almost half of your return comes from borrowings. The fact that you've geared into the investment. It's not really, only a little bit more than half is coming from the investment itself. So it doesn't really matter what that investment is. It's really mostly important about the borrowing, and that's that borrowing capacity or that level of gearing is what's going to drive your longer term returns. So sometimes we can be fixated on property, and of course property is easy to borrow against or borrow to buy, and it's got half the volatility of shares. So there is some fundamentals there, but really we've got to remind ourselves that if we borrow to invest, that's a good strategy in terms of long-term wealth accumulation. It's really then a question of what we invest in. And of course, there's two major growth asset classes being property and shares, and we shouldn't ignore the fact that we can actually borrow to invest in shares. And over the past 4 decades, both asset classes have delivered about 10% per annum over that very long period of time. So I think it's a reasonable assumption then that if you invest in either property or shares, that your long-term returns are going to be about the same. I don't think in the long run it's reasonable to assume that property is going to outperform shares or vice versa. I think they're really both very good asset classes. They're both got different levels of volatility, true, but over very long periods of time, the returns shouldn't be that much different. And so when we talk about volatility, what does that really mean? Volatility really means your expected return from year to year could be a lot different than the past year. So for example, shares have a volatility rate about 20%, and residential property in Australia has a volatility rate of about 10%, so about half the rate of volatility. So that volatility rate in mathematics is called a standard deviation. And we know that if we look at the median return and either add or subtract one standard deviation, that's going to give us the range of where our returns will be 70% of the time, statistically speaking. So if both property and shares are generating 10% long term, and for example, property's volatility rate is 10%, then you can expect 70% of your time, if you invest in property, your return will range between 0 and 20%. Whereas shares volatility rate is 20%. So therefore, you can expect 70% of the time that your annual return will range between -10 and +30, a much, much larger range than property. And that's why, to a lot of investors, property seems a bit safer than shares, because the range of returns that you should reasonably expect is a lot tighter, and most importantly, it's 0 to 20, so you don't have that negative return. Now, volatility really isn't that important in the long run. We don't really care about volatility in the long run. If you invest in an asset and it has high volatility, but it's a quality asset, if you invest in it, don't look at it for 20 years and come back, chances are you'll be very happy with the returns. Volatility only matters if we actually look at the returns on an annual basis, and we're sometimes encouraged to make changes as a result of looking at those returns, which is bad. So volatility only really matters then if you need to sell the asset sooner than you expect, or if you don't really have the appetite or the stomach to weather negative returns and then big positive returns, large differences from year to year. I think the second element, whether you've got the appetite for that risk, is really a factor of education. If you're going to invest and you're going to get some good quality independent financial advice to invest, well, then just follow that advice and don't worry about it and forget about it. Don't look at it if it's upsetting you. It's like people that look at their super balance every day and get upset when their super balance drops. Well, just stop looking at it, because you're not going to access super for some people for 20 years. So what's the point of looking at it today? Which is not to say that you shouldn't be concerned about it or have consideration to relative returns and fees and so forth, but it's really about volatility. Now, one of the common bits of sort of feedback or objections with shares is, Stuart, look, I own a property. I feel like I can understand the property market, but I don't know anything about shares and I wouldn't know where to start. And it's a common objection, I think, with people considering investing in shares. Shares are very subjective. Property tends to be quite objective. It's a question of fact of how big the land is, how good the suburb is, those sorts of things. But you don't need to be an expert. In fact, you can outsource the share investing part. And there's a lot of diversified exchange-traded funds, ETFs, that are listed on the ASX that allow you to invest in a variety of sub-asset classes, including Australian, international shares, emerging markets, smaller companies, bonds, all in one product that is all indexed and very low cost. And you can access those ETFs through an online share broker, so it's very cost-effective as well, such as CommSec or something like that. Vanguard has some diversified growth ETFs. The codes are VDGR and VDHG. Both of them are pretty good. They only charge 0.27%. So for every 100,000 you invest, you're paying only $270 in fees. So they're very cheap. BetaShares also has a good diversified growth ETF that doesn't actually have any bond exposure, whereas the Vanguard funds do have some bond exposure. Its ticker code is DHHF, and it charges 0.19%, so $190 for every 100,000 invested. And it also has some ethical alternatives that come at a slightly higher cost. I think if you're investing for someone that doesn't have any other assets, so quite often, investing for children or something like that, the Vanguard ETFs are quite good because they do have more of a diversified asset allocation, including bonds. If you're investing for yourself just because you want to have greater exposure to the share market and you've got other assets like cash in, offset accounts and investment properties and super and those sorts of things, then the BetaShare products might be more appropriate because they don't have any bonds and it gives you 100% exposure to the share market. Again, the links are in the blog on the website to those products, and they're both very good products. Of course, this is not direct financial advice, but it just demonstrating to you that that it's actually relatively easy these days and cost effective to invest in the share market. Okay, so how do you borrow to invest in shares? When investing in shares, sometimes it's good to use a bit of your own cash flow and also maybe some borrowings. So, for example, if someone came to me that had enough borrowing capacity and had a surplus investable cash flow of, say, $1,000 a month, what I might do in their situation is invest $1,000 a month plus maybe borrow $2,000 or $3,000, so invest $3,000 or $4,000 in total into shares progressively. And the way to do that is it's really just about establishing a new interest-only loan that might be secured by an existing property with some equity. The day after the loan is established, you would repay the loan. So if you borrowed, say, $300,000, you would repay $299,000. You wouldn't repay $300,000 because it'll close the loan. And then each month you just redraw $3,000, for example, and then together with your own $1,000 worth of cash, you can go and buy $4,000 worth of VDGR or DHHF, depending on if you're Vanguard or Beta shares. So it really is a relatively easy, I'm going to call you got to make the trade every month, but that's okay. And I'll talk about why that might be in a second. Now, the benefit of repaying and redrawing, or the benefit of that is it creates a very clear transaction trail that the debt has been used to buy assets that are going to generate taxable income and capital gains, and so therefore it's tax deductible. So that's why we repay and redraw each month. If you have a home loan, so non-tax deductible debt, you might actually choose to put that $1,000 into your home loan and instead borrow the full $4,000 a month to invest. Now, you've got to work out what's appropriate for your circumstances, what you can afford, what's safe, and certainly don't overdo it. But I'm only using these figures of $4,000 a month and so forth as an example. So let's think about then the cost of this strategy. Well, these diversified products over the last 3 years have paid an income of around about 6 to 8% per annum. So your interest rate's probably going to be around 6.5%. So this strategy should be self-funding. So that is that the income that you get from the investments should be enough to pay for the interest cost. However, I think the income will come down over time. I think there's been greater income probably because there's been greater volatility in the share market. And when you look at really long-term average incomes and there's going to be a little bit of turnover, maybe you should really do your numbers on 4 or 5% of receiving 4 or 5% of income. And therefore, you've got to fund the remaining difference between the income and the interest cost. Although I would probably recommend or encourage people to reinvest the dividends and pay for the full interest cost themselves, because I think that will just another way of really adding more income or adding more borrowings into the strategy and allow that sort of compounding returns. The last thing I wanted to consider was, should you invest on a monthly basis or should you invest in a lump sum? Because I read an article on Morningstar a few months ago that did a study and suggested that you're actually better off investing in a lump sum. So using my example, go out and borrow, say, $200,000 against your home and then go and buy $200,000 of these diversified shares tomorrow. That sounds pretty aggressive, and what I thought I would do is sort of crunch the numbers. And in fact, what I did is I had a look at what happens if we invested $300,000 in August 2001. That's when the ASX 200 index began. versus, instead of doing that, investing $6,250 per month for 4 years. So $300 in one lump sum, or monthly spread over 4 years, investing that $300,000. The third scenario I looked at was, what happens if we invest in a monthly basis, but messed up our timing completely and invested on the most expensive day of the month? So what I'm trying to work out here is, how important is timing? If I invest on a Monday versus a Wednesday, or if I invest today and the share market drops 1% tomorrow, do I need to worry so much about that? Well, when looking back, assuming we made the investment in August 2001, after a year, the lump sum generated a higher return. So it sort of shows the sooner we invest, or the more we invest sooner, the better off we are, which is kind of the reason why property works so well as well, because it's a lumpy asset and really forces us to invest more sooner. But when you look over a 20-year period, so a much longer time period, investing in a lump sum generated an average compounding return of 8.55%. Investing on a monthly basis, so drip feeding the money in over 4 years, produced a return of 8.16%, so about 0.4% less, but still a pretty good return. And terrible timing was 8.06%, so only 0.1% less than the just at the beginning, investing at the beginning of the month, so kind of random timing rather than really bad timing. So what can we draw from that? Well, we can draw that investing a lump sum in this situation, I'll go into a different scenario in a second, was much better. But in fact, spreading your money off in various tranches didn't really have a major impact on return. And in fact, if you're going to invest on a monthly basis, the timing of which you do that, so if you invest on a cheap day or expensive day of the month, doesn't really matter in the over the very long run. It does in the short term, but ultimately we're investing to generate good long-term returns. Now, I like investing in monthly tranches rather than lump sums. Lump sums feels very aggressive to me. So what I wanted to do then is ask myself, well, let's not invest in 2001. Let's invest at the start of 2007, about 1 year before the market crashed because of the global financial crisis. And so what I wanted to do is work out, well, what happens if I do that? Well, interestingly enough, after 1 year, of course, a lump sum has returned over 16%, and the tranches have returned only 5% because I've invested, only gradually over that year. But of course, then after that year, the market crashed. And so if I look over 16 years, so really 2007 through to today, the lump sum has returned 5.7%, and the tranches have returned 6.1%. So it does show that if you invest and relatively soon after investing, the market does drop and experiences some volatility, that investing in monthly tranches is safer and actually better and produces better longer term returns. The best way to look at it is, if I invest in tranches, sure, I could miss a little bit of the upside, but it's not that big a deal. The benefit of investing in tranches is I'm limiting my downside. And in fact, which I haven't really included in the analysis because it's kind of impossible to do, that investing in tranches allows you, particularly if you've got an advisor and you're not using these diversified products, allows the advisor to pick the markets that are most attractive in that particular month or that particular period, rather than just spreading it across the market. And so it gives you even greater chance to generate better longer term returns. So there you have it, a bit of a longer topic this week, but I guess what I was trying to encourage people to really think about is, if your borrowing capacity is restricting you, don't compromise on the quality of the asset. You can borrow to invest in other assets, such as shares, as I've gone through today, and you can do that in a way that I would argue is relatively safe. By borrowing against equity and property, you're not exposed to margin calls, so you can very much take a long-term view. You have to realize that it's possible that if you do embark on that strategy, at periods, particularly in the earlier years, you might have negative equity. That is, you might owe more money than the shares are worth. But if you invest in these products that I've just mentioned that are very low cost and fundamentally sound, index-based and evidence-based, and you are prepared to persevere with the strategy and hold those investments for more than 10 years and hopefully multi-decade periods, it is a very good way to build wealth. And also it's quite flexible. You don't, if your circumstances change, you can stop gearing, you can stop the investing. If in fact you find that it's very comfortable, then you can go and borrow more in the future and continue that investment journey, and or put more of your own surplus cash flow towards those investments. One final word of warning is that if you plan on investing a lot of money for a long period of time and you expect that your portfolio will be worth, say, somewhere between $500,000 to $1 million or more over the next 10 years, then it's probably worthwhile to get some financial advice in regards to this, because the diversified products are very good. But I believe that if you apply some professional asset allocation approaches, particularly if you're investing on a monthly basis, that should help you minimize risk in the portfolio and ultimately maximize returns. Okay, that's it for me for this week. Until next week, bye for now.